In today's digital financial world, our wealth bank balances, stock holdings, cryptocurrency exists as a series of digits on screens. These numbers represent our assets, our security, and our future, but they're no more than a visual abstraction, intangible promises in a complex digital ledger. What would happen if, one day, everyone demanded to withdraw their funds at once, hoping to turn digital representations into tangible cash? The answer is unsettling. Most would walk away empty-handed. This is the reality behind our banking system, a model based on fractional reserves. Banks only hold a tiny portion of the actual deposits they promise, with the rest tied up in loans, investments, or simply non-existent. This fragile setup can only operate smoothly when the public remains calm, confident that their money is safe. The moment that confidence wavers, whether due to panic, rumors, or broader economic instability, the system risks crumbling. Cryptocurrency exchanges highlight a similar but more precarious reliance on digital abstractions. Take Coinbase, one of the largest cryptocurrency platforms globally. In its terms of service, Coinbase acknowledges that customer assets may not be protected in the event of bankruptcy. Imagine logging in one day to discover that the Bitcoin, Ethereum, or other assets you thought you owned have vanished. This is a stark reminder that assets held on exchanges are, in fact, highly vulnerable to institutional instability. The issue goes beyond crypto. It's a systemic problem affecting nearly all digital assets. Look at your stock portfolio, for instance. The shares you own exist as numbers on a screen representative digital promises rather than physical stock certificates. Gone are the days when stockholders receive tangible documentation of ownership. Today, your connection to a company you invest in is tenuous, mediated by a complex web of digital infrastructure and financial promises, each layer adding fragility to your sense of security. In contrast, physical assets like gold and silver stand apart in their unshakable solidity. Gold and silver are tangible, immutable, and entirely in your control. When you hold physical metals, you own something of intrinsic value, untethered from the digital or financial systems that rely on trust and solvency. This ownership is simple and absolute. There's no counterparty risk, no dependency on the operational health of a bank, brokerage, or exchange. Whether you hold coins, bars, or jewelry, physical metals retain value regardless of economic upheaval, financial crises, or institutional collapse. Unlike digital assets, which hinge on the stability of technology and systems that can fail, gold and silver remain steadfast and resistant to the forces that erode the value of other assets. Consider the U.S. dollar as an analogy for understanding the value of physical assets. Visualize the dollar as water filling a bathtub, while gold and silver sit as solid bars on the edge. Right now, the dollar appears stable. The bathtub is full. But pull the plug, and the dollar's purchasing power begins to drain. This process isn't gold and silver becoming inherently more valuable. Rather, it's the dollar losing value, causing the metals to stand out as more desirable in comparison. Precious metals do not inherently grow or shrink in value. They serve as benchmarks of stability. What fluctuates is the dollar's worth in relation to these metals. As the dollar erodes, its weakness makes gold and silver appear stronger, even though their intrinsic value remains constant. This dynamic is essential for understanding how precious metals serve as a hedge in times of monetary instability. History provides stark examples of the dangers of relying on fiat currency. The hyperinflation in Weimar Germany after World War I is one of the most infamous cases. Inflation spiraled so rapidly that Germans had to carry wheelbarrows full of paper currency to buy basic necessities, such as a loaf of bread. Often, by the time someone exited the store, the currency's value had dropped further, making the goods even more expensive. In some cases, thieves would steal the wheelbarrows, but leave behind the currency, illustrating how utterly worthless it had become. This historical example serves as a visceral reminder: fiat currency, backed only by government promises, can disintegrate, rendering entire economies impotent. In such circumstances, physical assets like gold and silver not only retain value, but become essential lifelines for those who hold them. In today's world, we're beginning to see the early signs of the U.S. dollar's decline as the global reserve currency. This shift isn't sudden but gradual, driven by geopolitical shifts and the actions of nations seeking to reduce their reliance on the dollar. Over the past few years, countries like Saudi Arabia, Russia, and Nigeria have started trading in alternative currencies. Saudi Arabia, for instance, has begun selling oil to China in yuan. Russia and India are settling trades in rubles, while Nigeria now accepts yuan for its exports. This trend is not a mere coincidence. It reflects a deliberate strategy by nations to mitigate the risks associated with dollar reliance, especially after the United States removed Russia from the SWIFT banking system as part of economic sanctions. The U.S.'s action sent a clear message to the world. The dollar is not only a currency, but also a tool of political leverage. As a result, countries have begun to seek alternatives to shield themselves from potential sanctions or financial isolation, moving toward a multipolar financial landscape. The true reckoning could come if OPEC, the powerful oil cartel, decides to accept payments in multiple currencies instead of just the dollar. This move would signify the end of the petrodollar system that has bolstered U.S. economic dominance for decades. Once the petrodollar system collapses, dollars currently held in foreign reserves around the world could come rushing back into the U.S. economy, sparking massive inflation. This influx would devalue the dollar rapidly, making the current inflationary pressures seem mild by comparison. If countries start abandoning the dollar for alternative currencies, demand for dollars will plummet, driving its value down even further. Such a situation would create an economic maelstrom, with skyrocketing interest rates and a potential collapse of foundational assets like stocks, bonds, real estate, and, indeed, the dollar itself. In this context, physical silver becomes particularly compelling. Known as the poor man's gold, silver offers an accessible way to hedge against financial collapse. It has historically been more affordable than gold, but its potential for appreciation remains strong. Currently, the gold-to-silver ratio is around 83:1, suggesting that silver is vastly undervalued relative to gold. Historically, this ratio has averaged closer to 42:1, and in the Earth's crust, the natural occurrence ratio of silver to gold is around 7:1. These disparities indicate that silver is priced far below its natural and historical value, creating a unique opportunity for investors. Buying silver now, while the ratio is skewed, enables one to potentially exchange it for gold if and when the ratio normalizes. If the ratio reverts to its historical average, silver holders could double their purchasing power relative to gold, a strategic advantage in an unstable economic climate. Gold, however, remains the ultimate store of value. Under Basel III regulations, central banks have reclassified gold as a Tier 1 reserve asset, treating it as a risk-free asset comparable to cash. This reclassification underscores gold's unrivaled status as a stable and secure reserve, appealing to central banks that recognize its role as an anchor against currency devaluation. While silver may offer a path to wealth preservation, gold represents the ultimate safeguard. Central banks around the world are accumulating gold in preparation for an uncertain future, aware that when fiat currencies falter, gold stands resilient. Unlike fiat currency, gold isn't an investment, it's insurance, a financial stronghold. Imagine a future where a coalition of BRICS nations Brazil, Russia, India, China, and South Africa introduces a new global reserve currency, pegged to gold, and tracked via a transparent distributed ledger. This would create a currency with genuine backing, unlike the U.S. dollar, which relies on an over-leveraged foundation of debt and unfunded liabilities exceeding $130 trillion. A currency backed by gold would provide stability and would be highly attractive to countries wary of the U.S.'s economic dominance. The world would quickly pivot toward such a currency, accelerating the decline of the dollar's reserve status. Those holding physical gold and silver would find their wealth preserved, while those holding dollars would see their purchasing power severely diminished. The U.S. dollar's fall would not only shift economic power, but also redistribute wealth dramatically toward those holding tangible assets. In summary, the choice to hold gold and silver in today's financial landscape is not about speculative gains. It's about safeguarding wealth against an increasingly fragile financial system. Precious metals provide a hedge against the volatility of fiat currencies, stocks, bonds, and real estate, which could all suffer devastating losses in a dollar collapse scenario. Gold and silver have preserved wealth through history's many economic crises and collapses, including the rise and fall of empires. In times of profound uncertainty, they remain the ultimate safeguard. When paper promises fail, when digital abstractions vanish, gold and silver endure, maintaining value across centuries. As the dust settles on a redefined global monetary order, those who chose to secure their wealth in tangible, immutable assets will find themselves on stable ground. Those who relied solely on fiat currency and the promises of financial institutions may find themselves with nothing but devalued, empty promises. The choice is clear. Continue to trust in a faltering currency or secure your wealth with assets that have survived and thrived through humanity's turbulent history. The decision lies not in speculation, but in the preservation of financial sovereignty.